gonna learn about investment. Okay, so this is the objective of learning this chapter, and I think you can understand by yourself. You can read by yourself. 1 2 3 4 5 6 7 8. There are 8 objectives that we hope that you can get all of the objectives at the end of this chapter. Well, I would like to start the explanation from this slide. Okay, why do we need to make investment? Okay, the first reason is we make investments because we want to get capital appreciate, or we call it as capital gain. Okay, we make investment because we want that money that we invest in become higher in the future. Okay, because of the value of the capital is higher, because of the appreciation of the value, yeah, and so on and so on. There are many causes. Okay, and the second objectives is the second reasons why people make investment, why companies hold investment, is because they want to get dividends. Okay, dividends is the income for the investor. Okay, so dividend, the investor will get the dividend from the investee. Okay, if you invest in a company, your company is the investor, you are as the investor, and that company is the investee. Okay, and then there are two basic types of investment. Firstly is debt instruments, and the second one is equity instruments. Okay, debt instruments, as the name says, debt instrument, the investor pay cash upfront and obtain the right to receive interest and to return and to the return of principal. So if you invest in that instrument, okay, you will pay cash, and then you will get the interest once in a year or every 6 months. It depends on that company, and then you will get the return of the principal. Return of the principal means how much money you invest. For example, you give the money as much as 500,000, then you will get back 500,000. So the 500,000 is the principal. We call it as principal. Okay, so the example of that instruments are government and corporate bonds, convertible debt, and commercial paper. Okay, done for debt instruments. And the second one is equity instruments. For the equity instruments, the investor pays cash upfront and receive rights to dividends, to vote, and to residual asset upon liquidation. So you are as the investor, you will give money, you will put the money into that company, and you will get dividends. It depends on the investee. Okay, you will get dividend as the income, and you will get the voting power. It depends, yeah. It depends on how many percentage you own. It depends on the ownership level. Okay, and then to receive the residual assets upon liquidation. Liquidation in this case means if the company goes bankrupt, if the investee, yeah, if that company goes bankrupt, then they need to sell all of their assets. Okay, the first priority, if a company is liquidated, the first priority is to pay all of their debt. Okay, and the last priority is to give back to the investor. Okay, so you will get the last priority as the investor. That's why we call it as residual assets from the liquidation. Okay, and the examples of equity instruments can be common stock and preferred stock, or warrant rights and call options. And then companies that have investment because they want to get the returns in terms of interest, dividends, and capital appreciation. I mentioned that already in the previous slide. Sometimes they want to get influence or to control other companies. We call it as corporate strategy, because if you have investment in that company, you will have influence. You can control that company. Okay. And for banks, they will invest the money that they get from the customers at a higher rate. Okay. And then for the companies that don't have investment, it's better for them to reinvest the money into the business, okay, or retire the debt or pay dividends to investors.